Most people who try to build wealth fail not because they chose the wrong stocks, but because they couldn't handle the silence of the first 5 years. In the beginning, dividend investing feels like watching paint dry in a cold room. You sacrifice a portion of your hard-earned paycheck, you buy shares of a stable company, and a few months later, the system deposits a few dollars into your account. It's barely enough to buy a cup of coffee. This is the exact moment where the average person gives up. They look at their small payout and compare it to the volatility of the market or the latest trending asset, and they decide that waiting decades for a dividend is a waste of time. But what if the lack of early results is actually a filter designed to reward only those with the stomach for the long game? To understand the architecture of true wealth, we have to stop looking at a dividend as a bonus and start looking at it as an unpaid employee. Every time you receive a dividend and reinvest it, you are effectively hiring more workers to go out and bring back even more money. You aren't just saving, you are building a self-perpetuating machine. Let's look at the mechanics of this machine through a perspective most people ignore: the compounding of the dividend itself. Most investors focus on the stock price going up. That's capital appreciation, and it's great. But the real secret of the world's most successful portfolios is the intersection of a rising stock price and a rising dividend payment. Think about a company that has not only paid a dividend for 60 years, but has increased that payment every single year without fail. This isn't a hypothetical scenario. These companies exist and are often referred to as dividend kings. They have survived recessions, wars, and shifts in global trade. When you own these, you aren't gambling on a price chart. You are owning a piece of a cash flow engine. Do you currently have an investment strategy that pays you more every year just for holding it, regardless of what the broader market is doing? Most people don't. They are stuck in a cycle of buying high and selling low, chasing the next big thing while ignoring the mathematical certainty of the dividend reinvestment plan. To see how this works without the distraction of market noise, imagine you take a single sum of $1,000. You place it into one of these high-quality, dividend-growing companies, and then you do absolutely nothing for 25 years. You don't add another penny, you just let the machine run. In this scenario, there are two distinct paths you can take. Path A is the consumer path. You take your dividends every quarter and you spend them. Maybe you buy a nice dinner or put it toward a utility bill. Path B is the architect path. You set your account to automatically reinvest every single dividend back into more shares of that same company. After 25 years, the difference between these two paths isn't just a few dollars, it is a total divergence of reality. On the consumer path, your $1,000 might grow to be worth roughly $6,000. You also collected about $4,000 in cash dividends over those years. Total value, around $10,000. That's a tenfold return, which sounds decent until you see what happened on the other side. On the architect path, where every dividend was used to buy more shares, that same $1,000 has turned into nearly $24,000. That is a difference of $14,000 purely because you chose to buy more employees instead of spending the harvest. The logic here is simple but profound. When you reinvest, you are buying more shares. Those new shares then pay their own dividends. Then those dividends buy even more shares. It is a loop that gets wider and faster every year. By the end of this 25-year period, your annual dividend payment alone would be over 160% of what you originally invested. Think about that for a second. Every single year, the company is handing you more money than your entire original investment from 25 years ago. This is how the dividend becomes a tool for absolute financial freedom. If seeing the math behind this reinvestment strategy is helping you realize how much potential your future holds, take a moment to hit the like button and subscribe. It helps us keep these deep dive analyses coming. Now, let's look at what happens when you turn this small spark into a massive fire. A one-time investment of $1,000 is a great proof of concept, but very few people retire on $24,000. The real power of the dividend philosophy is revealed when you apply a disciplined monthly contribution. This is where we move from saving for a rainy day to building a generational empire. Imagine a professional who decides to commit $1,000 every single month into this dividend growth strategy. Over 25 years, they will have contributed $300,000 of their own money. To most people, $300,000 sounds like a lot to save. But wait until you see what the dividend snowball does to that number. If this investor chooses not to reinvest their dividends, they end up with a portfolio worth about $877,000. If you add in the cash they took out and spent over the years, their total wealth created is about $1.3 million. That's a millionaire status, and for many, that's the dream. But for the dividend reinvestor, that's just the baseline. The investor who reinvested every single dividend ends the same 25-year period with a portfolio valued at over $2.3 million. That is a $1 million gap created simply by the choice of what to do with the dividend check. But the most staggering number isn't the total value, it's the paycheck. By year 25, the reinvestor is receiving an annual dividend income of $157,000. That is more than many people earn at the peak of their careers, and it is being generated entirely by their assets. At this point, you are no longer working for money. Your dividends are working for you. You could effectively retire and live off that $157,000 without ever selling a single share of stock. Your principal remains untouched, and because these are dividend-growing companies, that paycheck will likely keep increasing every year, protected against the rising costs of living. Do you know what your freedom number is? The amount of annual dividend income you would need to never have to work again. If you haven't calculated it, you are essentially sailing without a map. Most people focus on the big pile of cash theory of retirement, but the perpetual income theory of dividend investing is far more sustainable. What happens if you don't stop at 25 years? What if you have the discipline to go for 30 or 35 years? This is where the math starts to look like science fiction. In the final decade of a long-term dividend strategy, the growth becomes vertical. If you continue that $1,000 a month habit for 35 years and keep reinvesting, your portfolio doesn't just grow, it explodes. We are talking about a total value of over $11 million. But the truly insane part, and I use that word carefully, is the annual dividend income. After 35 years of reinvesting, your annual dividend payout would be approximately $1 million per year. Let that sink in. You invested a total of $420,000 over 3.5 decades, and the dividend reward for your patience is $1 million every single year for the rest of your life. Compare that to the person who didn't reinvest. They would still be doing well, but their annual dividend would only be around $200,000. The gap between reinvesting and not reinvesting at the 35-year mark is nearly $800,000 in annual income. This is the cost of impatience. The lesson here is that time is the most valuable asset in the dividend investor's toolkit. Every year you delay starting, or every time you dip into your dividends to buy a luxury you don't need, you are cutting off the top of that massive growth curve. You are essentially stealing from your future self's $1 million a year salary. This is why dividend investing is often called the get-rich-slowly scheme. It's not flashy. It doesn't make for exciting headlines. It requires you to be okay with looking boring for the first decade. But the mechanical reality of the math is undeniable. The snowball starts small, but once it gains enough mass, nothing can stop it. The system is designed to reward those who can defer gratification. Most of the financial world wants you to trade, to jump from one hot stock to another, because that generates fees for brokers and excitement for the media. But the dividend growth investor sits quietly, reinvests their payouts, and lets the greatest companies in the world do the heavy lifting for them. Before we wrap up this look at the long-term power of dividends, I have to ask, what is the biggest thing holding you back from starting a long-term reinvestment plan today? Is it the fear of a market crash, or just the feeling that you don't have enough to start with? Let's talk about it in the comments. Building a portfolio that can sustain you for life requires more than just picking the right stocks. It requires understanding how to maximize the engine once it's running. We just saw how massive a portfolio can grow over 35 years, but many people wonder if they can achieve freedom much sooner with a different focus on yield. I break down exactly how that works in this video right here. Watch that next.